Welcome back to the deep dive. Today we are analyzing a monumental shift in the financial architecture of the world's fifth largest economy, India, the massive consolidation of India's public sector banks, or PSBs. I'm Nisha Das and my colleague is Sunil Chopra.
Yeah, it's huge. Over just a few short years, this wave of mergers reduced the total number of state-owned lenders from 27 down to just 12.
And this isn't just administrative shuffling, is it? It's a complete structural redesign of their financial system.
We're going to track the timeline, critically look at the data from the mergers that have already happened, and importantly, try to unpack the nuanced reasons why maybe some of those ambitious goals haven't quite panned out as expected.
Right, and our sources today give us a pretty good 360-degree view. So let's start with the why. What were the big objectives driving the government to push this consolidation so hard, especially starting around 2017?
Okay, the rationale really hinges on fundamentally improving two things: stability and scale. So first, the most immediate driver was strengthening financial stability.
Hmm? Hmm?
This basically means merging banks that were burdened by too many bad loans, what we call non-performing assets or NPAs, with healthier banks. The idea is the larger entity can absorb those shocks better and improve overall risk management.
So it's kind of a necessary cleanup, but spreading the risk across a bigger balance sheet.
Precisely. Then the second goal is increased operational efficiency. The promise here is synergy, right? Reducing overlapping admin structures, optimizing branch networks that might be redundant, streamlining HR, all to cut costs.
Makes sense on paper.
Okay, the third reason is improved lending capacity. Simply put, bigger banks have more capital. That allows them to underwrite larger loans needed for big businesses, major infrastructure projects, and also maintain competitive rates for retail borrowers.
And that's critical, isn't it? You need that financial firepower to actually fund national development goals.
Totally. Which leads directly to the fourth objective, global competitiveness. These merged banks with much larger balance sheets positions them to compete on a global scale. You know, attract foreign investment, handle complex international deals,
Okay.
and finally number 5, better governance and oversight. The hope is that the new post-merger structure fosters stronger internal controls and reduces the scope for external interference.
And there was that high level economic goal providing context too. Our sources mentioned the strategic target from 2019: create lenders that could specifically support India's push towards a $3 trillion GDP target.
Yeah. So this whole exercise was explicitly tied to macroeconomic growth ambitions.
Okay.
Looking back, structural banking reform in India isn't new, but the shift after 2017 was tectonic. It dramatically reduced the number of PSBs down from 27 to just 12 by April 2020. A huge change in a short time.
Let's trace the path of these mega mergers then. Phase 1 started by anchoring things around the State Bank of India, right?
Correct. It saw the consolidation of 5 SBI associates and the Bharatiya Mahila Bank, BMB, into SBI itself back in 2017. That instantly created the largest PSB by far.
Okay.
And that was followed in 2019 by the three-way merger of Dena Bank and Vijaya Bank into Bank of Baroda.
And then came the really big one, the April 2020 mega merger.
Right. The scale was immense. 10 banks funneled into just 4 massive entities. Take Punjab National Bank, PNB. It absorbed Oriental Bank of Commerce and United Bank of India.
Right.
That single move created India's second largest PSB. Its business size shot up to 17.95 lakh crore. Just to give that some global context, that's roughly $215 billion in size.
Who else emerged from that big 2020 reshuffle?
Well, Canara Bank merged with Syndicate Bank, becoming the fourth largest PSB.
Okay.
Union Bank of India took over Andhra Bank and Corporation Bank, making it the fifth largest. And Indian Bank merged with Allahabad Bank, creating the seventh largest PSB. These were all supposedly strategic pairings, often aiming to combine banks with complementary regional strengths.
Now, to make that kind of rapid change work, the government had to step in financially, right? The finance minister announced a pretty substantial recapitalization plan.
Yes, a massive infusion of 50,000 crore, that's over $6.6 billion dollars, injected into these banks, both the merged entities and some that weren't touched. PNB, because it took on so much, received the biggest chunk of that capital.
That's a staggering amount of taxpayer money going into banks restructuring.
Right.
Now, let's shift gears and do the customer reality check. If you banked with, say, Oriental Bank of Commerce, what was the immediate practical impact for you?
Yeah, this is where those hoped for efficiency gains often didn't feel so smooth for the customer. The core issue was account migration. Now, although your balance and standing instructions were meant to carry over seamlessly into the anchor bank's core banking system,
And what's the biggest headache there, usually?
getting entirely new credentials. Customers pretty much universally had to deal with new account numbers, new IFSC codes. It meant you had to manually update every single third-party link, your salary mandates, utility bill payments, ECS, all your UPI settings. If you missed one, transactions just failed.
Ouch.
And on top of that, all the digital services moved to the Anchor Bank's platform. So re-registering for mobile banking, internet banking, often with fresh credentials, it wasn't exactly seamless, especially initially.
We also heard a lot about the impact on jobs. After all, the whole point of operational efficiency often implied manpower reduction, although this was downplayed.
Exactly. While employees were generally retained, mergers inevitably lead to duplication of roles. So the efficiency drive translated into large-scale voluntary retirement schemes or VRS,
Ah, right.
and also consolidation or relocation of overlapping branches. Now loan terms, EMIs, they generally stayed stable, but interest rates on deposits and service charges across the board were pretty quickly harmonized to the anchor bank's levels, which often meant lower deposit rates or higher fees for the customer.
Now let's get into the deep dive on results. What's fascinating here is that while the goals were all about stability and efficiency, the historical data from earlier consolidations suggests success wasn't guaranteed.
That's true. And there were clear warnings from the past that seemed to have been ignored. Way back in 1998, the Narasimham Committee specifically cautioned that mergers should ideally happen between banks of equivalent size.
Right?
And critically, they warned against forcing profitable banks to acquire loss-making ones.
And looking at the 2020 mergers, that warning was partly ignored.
It was. The classic example was the profitable Indian bank being tasked with taking over loss-making Allahabad Bank, which had posted a net loss of over 83 billion crores or $1 billion the year before.
Wow.
So mergers immediately transferred the weakness, the non-performing assets or NPAs, onto the healthier bank's balance sheet, stifling their capacity to lend right away.
Doesn't that immediately put the healthier anchor bank under pressure and potentially hinder its ability to provide capital for growth, thus undermining that third strategic goal, at least in the short term?
It did, and the data tends to bear this out. Let's look at two key financial metrics. First, gross NPA, basically how many bad loans a bank is carrying.
Okay.
Second, the cost-to-income ratio C/I. That's operational expenses divided by revenue, a core measure of efficiency. Lower is better.
Right, so how did those initial big mergers perform on those metrics?
Poorly initially. In the 2 years after the big SBI consolidation in 2017, their C/I ratio actually worsened. It jumped from about 47.75% to 55.7%.
Less efficient.
Yes, and gross NPAs also worsened, going from 6.90% to 7.5%. We saw a similar pattern with the Bank of Baroda merger in 2019. Its gross NPA jumped from 9.61% to 10.28% post-merger.
But why does the C/I ratio spike like that? If the whole point of merging is efficiency, why are costs actually rising initially?
Yeah, this is the critical piece often missed in the headlines. Those efficiency gains are delayed because the operational complexity is too immense. You're talking about merging fundamentally incompatible core banking systems.
I guess it's like trying to merge two different railroads built on different track gauges while the trains are still running.
Exactly. It's incredibly difficult. You have massive IT integration costs. You have cultural inertia between the merged staff, union resistance, all slowing down the realization of those hoped for synergies.
That makes the relative success sometimes seen in private sector mergers, like Kotak Mahindra taking over ING Visya, stand out even more.
They often did achieve financial success more quickly, notably in their CASA ratio. CASA stands for current account and savings account deposits for banks. That's their cheapest sorts of funds.
Right.
Private mergers sometimes saw higher CASA ratios and lower C2I ratios faster because they often faced less staff resistance, had smaller legacy systems maybe, and employed more streamlined, perhaps more aggressive technology adoption strategies right from the start.
And the projections for the big 2020 mega mergers showed similar initial pain points, didn't they?
Yes, exactly. Entities like the merged Canara Syndicate Bank were projected to see an increased C2I ratio and higher gross NPA levels right out of the gate.
And the so what of that higher C2I ratio?
Well, it means reduced profit per branch, which is precisely why, despite official reassurances about jobs, the pressure for manpower rationalization through things like VRS remains a constant underlying factor.
Okay, if we connect this to the bigger picture now, we have to talk about systemic risk. By consolidating 27 banks down to 12, the government is essentially creating fewer but vastly larger entities.
Yeah,
Many of these become systemically important banks or SEBs.
right. And SEBs are generally seen as too big to fail, TBTF. Now, while that scale gives you global competitiveness, it also concentrates risk significantly. If one of these giants gets into trouble, the shock to the entire economy is potentially huge.
Okay,
We should remember the lesson from the global financial crisis, right? In the US, smaller community banks often actually performed better and increased their lending when the big Wall Street institutions were struggling and pulling back.
that history definitely informs the core critique we see in some analyses, that regional focus, that local knowledge inevitably gets lost in these huge national mergers. And the weaknesses of the smaller bank just get transferred, diluting the strength of the larger one.
Precisely.
So, what were the main alternative suggestions experts were raising, if not consolidation? How else could the sector be strengthened?
The alternatives generally focus more on operational and governance fixes rather than just structural change. The consensus seemed to be around three main points. First, a radical improvement of asset quality, cleaning up bad loans, and reducing external interference, specifically the political pressures that sometimes lead to things like populist loan waivers.
Okay, less interference, better loan books.
Second, much more aggressive use of technology. Using tech to fundamentally bring down that cost-to-income ratio, potentially bypassing the need for quite so many painful branch closures or staff reductions.
And the third alternative centered on capital, I imagine.
Absolutely. Allowing the profitable, healthier PSBs to raise capital directly from the market, instead of constantly relying on taxpayer money. The idea is this would subject them to market discipline, improve governance, and reduce the constant strain on the government's budget from huge capital infusions.
This has been a really revealing deep dive. I think the core takeaway for you, as the listener, is that India's bank merger strategy is definitely driven by clear, ambitious goals.
Yeah, global scale, financial stability. That's understandable.
But the historical data really proves that success isn't automatic. It's highly dependent on execution, especially navigating incredibly complex integration of IT systems and managing cultural inertia when you combine weak and strong institutions.
Yeah. And this raises a really important and uncomfortable question to ponder. The creation of fewer, vastly larger banks, often with implicit government bailout guarantee, Could that inadvertently lead managers to be less careful in their lending decisions, knowing deep down that the state will likely step in if things go wrong?
Hmm?
So, what are the long-term trade-offs we're making here? Between pursuing that global scale through massive consolidation versus maintaining robust, perhaps more cautious domestic banking practices spread across a more diverse range of institutions.
It definitely leaves us wondering about the future structure.
Yeah.
Will we eventually see a renewed appreciation for more local focused banking that might be better insulated from big systemic shocks? Or is further consolidation inevitable in the relentless pursuit of becoming a global financial power? Something important for you to mull over?
Thanks for joining us. If you liked today's episode, please share, like, comment, and subscribe.